BlackRock CEO says Bitcoin is digital gold. Is a $150,000 Bitcoin price prediction still on the table? We'll cover the latest CPI report and what it means for your crypto portfolio. Don't miss out. Watch now. In the latest video from Altcoin Daily, Larry Fink, CEO of BlackRock, warns investors about a potential recession. He suggests Bitcoin as a valuable asset during times of economic uncertainty, comparing it to digital gold. Fink highlights BlackRock clients' increased interest in navigating the current market, with many exploring Bitcoin allocations. Despite the current market downturn, Fundstrat's Mark Newton suggests the stock market may have bottomed, predicting sideways movement for 1 to 2 months, followed by a potential rally. Fundstrat maintains its $150,000 Bitcoin price prediction for this year. Bitwise confirms Bitcoin is being withdrawn from exchanges, indicating a potential supply squeeze and a possible rapid price increase when the market recovers. Bitcoin exchange balances are at their lowest since 2018. While Fink's endorsement of Bitcoin as a hedge against economic uncertainty is noteworthy, it's important to approach such predictions with caution. The current macroeconomic climate is indeed complex, with recessionary fears and inflationary pressures. However, Bitcoin's volatility remains a significant concern for many investors, and its correlation with traditional markets has increased recently, potentially diminishing its safe haven appeal. While the decreasing Bitcoin exchange balances could suggest a future price surge, it's crucial to remember that market sentiment can shift rapidly. A balanced portfolio and thorough research remain essential, especially in uncertain times. In the latest video from CryptosRus, the Dow Jones saw a huge jump of nearly 3,000 points or 8% and Bitcoin rallied to $82,400. This follows Trump's announcement of a pause on some tariffs for all countries except China. There's speculation that this move was influenced by Japan and China selling off U.S. Treasury bonds. Despite the market rally, the chance of a June rate cut has dropped to 13%. The video also covers positive crypto news like Paul Atkins' confirmation as SEC chair, potential spot Ethereum ETFs, and rising XRP and Solana addresses. The host reiterates his belief in Bitcoin and DCA, showing his own portfolio, which is up 45% despite the market downturn, and plans to continue DCAing into Bitcoin, XRP, and SOL. Bitcoin price prediction hit $100,000. While the market's positive reaction to the tariff pause is encouraging, it's important to approach this with cautious optimism. The situation with China remains tense, and other countries might retaliate. The lower probability of a rate cut is also a concern. However, the positive developments in the crypto space, particularly with regulations and potential ETFs, offer a glimmer of hope for long-term growth. It's crucial to remember that market fluctuations are normal, and a long-term DCA strategy can help weather these storms. Personally, I believe that focusing on fundamentals and staying informed is key to navigating the ever-changing crypto landscape. In the latest video from Crypto Banter, the host discusses the recent market shift and the potential for a bullish reversal. He notes that while the market has been bearish, good news can trigger bounces, as seen recently. He's watching for Bitcoin to break a key trend line, which could lead to further upside. He suggests that if the current low holds, another leg up is possible. The host analyzes CPI data, suggesting two scenarios: a trap, where Bitcoin drops to $78,000 to $80,000 before pumping, or a direct rocket if CPI is below expectations, 2.5%. He advises viewers to prepare for both, highlighting potential resistance at $86,000 and a possible path to $100,000. He reviews altcoins, including ETH, Solana, Chainlink, XRP, and Cardano, noting similar patterns and entry points. The host mentions Altcoin as a potential high-risk, high-reward meme come play and promotes a limited-time offer from Allbank Exchange. While the host's enthusiasm is infectious, relying solely on technical analysis and short-term market fluctuations can be risky. CPI data is indeed a significant factor, but broader macroeconomic trends and regulatory developments also play a crucial role. The mention of Altcoin, while potentially lucrative for some, underscores the speculative nature of meme coins and the importance of due diligence. Diversification and a long-term investment strategy remain key, especially in volatile markets like crypto. In the latest video from Cowen, he discusses the recent CPI report, which showed a drop to 2.41%, better than the predicted 2.6%. He points out this is a positive shift, as inflation had been rising since September, even with the Fed's rate cuts. Cowen examines inflation by category, noting housing, a major contributor to the overall rate, decreased. He also points out that core inflation dropped significantly to 2.8%. While cautious about celebrating prematurely, Cowen acknowledges this move is positive and could lead to looser monetary policy. He suggests that market attention may shift from inflation to the labor market, as the inflation rate is nearing the Fed's 2% target. Looking at Bitcoin, he notes a recent drop of 3 to 4%, but maintains his stance that things are okay as long as Bitcoin stays above the 2024 high. He mentions that April OPEX is approaching and could be an important date. Cowen closes by discussing the S&P 500 and its relationship with the unemployment rate, suggesting this metric is important to watch in the coming weeks. Cowen's analysis of the latest CPI report offers an interesting perspective. The drop in inflation is indeed good news, but as he correctly points out, it's too early to declare victory. Current news suggests a mixed economic outlook, with some indicators pointing to a potential recession which would impact markets beyond inflation. While lower inflation could mean looser monetary policy, which could benefit risk assets like Bitcoin and gold, the looming potential for job cuts and an economic slowdown can't be ignored. A balanced approach, considering both the positive inflation data and broader economic uncertainty, seems warranted.